Good morning, everyone. Welcome to November's monthly market session, Thanksgiving edition. Temmie, how you doing today?
Good.
We will follow about the same format. Going to introduce ourselves really quickly, run through the outline, and then go ahead and get started. I am Paul Nalabondian, attorney licensed in the District of Columbia, also realtor licensed in Virginia, DC, and Maryland. Second part is probably a little more relevant to this session. I'm your local market expert. I am a team leader on Fulcrum Residential, a top-ranked team in the country for real estate, just an incredible team. And we are proudly affiliated with Keller Williams Capital Properties. If I'm not mistaken, they are the #1 brokerage in the nation and I think in the world. Temmie, correct me if I'm wrong. And I am joined up, also proud to have served on the Agent Leadership Council going on 6 years now, and we'll probably do it again next year. Talking about that right now. All right, Temmie, introduce yourself to the wonderful folks out there.
I am Tenny. Thank you. Thank you, Paul. Take it away.
All right. There's no minimum or maximum requirements for introduction. All right, we're gonna go ahead and get started. My system is lagging just a little bit, but hopefully that won't be much of an issue. Okay, following the same format that we generally do. Oh, before we get started, Temmie, you're usually the one who reminds me to say this by reminding me. I say you share with the folks. Let us know. We'd love to hear in the comments your name, if you're an agent, industry professional, or just a consumer, where you're licensed, where you live, and if you have any specific questions or items you would like covered today, any areas of concern. We would love to have this as interactive as possible. So please keep the comments coming throughout. And just want to throw out there, if you're watching this later on YouTube on the video, I would love to hear more in the comments, kind of your feedback. Are you getting value from this? What would you like to see? Am I spending too much time on certain aspects? Always want to tailor this as much as possible to the needs out there and the demand out there. So love to hear feedback, love to hear comments, if not in real time, later on in the video. Okay, starting off, we are going to look at the overall economy. And the reason why we look at the overall economy is because that's what impacts mortgage rates. So we're going to take a look at mortgage rates, all the various products there. We're also going to take a peek at what's happening with the federal government. There has, rumor has it, it is active and running again. So hopefully running smoothly, if not now, sometime soon. Then we are going to look at real estate specific data, going into the DMV data for the most recently reported month, which is October. Then we are going to look at the reported week so far in November. We're going to look at kind of the government effect on reopening real estate, how all that is looking. And then we're going to close it with some key takeaways. All right. Where are mortgage rates at? What are people seeing?
Before we get started, Paul, no
And
coffee
here,
this morning?
so we're, oh, Temmie, thank you so much. I don't know how I forgot that. When I said Thanksgiving edition, I started thinking about food. I got really hungry. I was envisioning turkey and all of this stuff. But no, yes, thank you. Coffee of the day is a wonderful coffee from the Kamwangi washing station in Kenya by way of MAME coffee in Switzerland, Zurich. I recently had a wonderful trip there, spent a lot of time in both of MAME's Zurich cafes. And I would have to say, if anybody loves coffee and is there, definitely stop in. One of the best cafe experiences I have ever had. The coffee is top notch, incredible pour over, incredible espresso, but also a very knowledgeable and kind staff. So this is a delicious washed Kenyan coffee. Absolutely wonderful. If any of the Fulcrum folks on here think this sounds particularly delicious, let me know and I'll bring some into the hub. Okay. Now I might have missed as I was pouring literally and figuratively into the coffee. I might have missed if this came up in the comments, but I'm about to share what's being publicly reported for mortgage rates, but it's one of the great areas of value that comes from this community experience is hearing what people are getting with actual clients locking in. So if anybody has locked a client in the last week, I would love to hear what that rate was. Please let us know what type of product it was, if it was conventional, FHA, VA, and then also whether it was condo or fee simple, because rates can vary between the two. And if we have our lender partner, Mark Lankowitz, on here, I would also love to hear what your clients have been locking in within the past few days, past week. Welcome, GM, newly licensed with KWCP. Welcome. Great to have you on here. Morning, Ty.
I think, Mark,
6125.
yeah, Mark
That's
was
a
able
fairly good rate.
to.
That's
Sorry, I was going to say Mark was able to lock one of our clients that was a VA right under 6%.
Nice, nice. Both of those rates are a little under what is being publicly reported right now. So that is great to hear. As you can see, as of, I think I pulled this 2 days ago, but hasn't changed. It's the reported numbers are right the same. We're right around 638. So we are about 20 bips higher than we were when we met last month. Yeah, 636 is what was reported yesterday. I don't think they've announced today. Speaking of announcing today, sorry to be all over the place here, but I think the jobs report. Yeah, so the jobs report is coming out today. It was supposed to be released, I believe, at 8:30. So just a couple of minutes ago, we got on right at 8:30. So I haven't had a chance to look yet, but I'll try to kind of peek out of the corner of my eye as we move forward. Anyways, getting back to mortgage rates. Yeah, so about 20 bips higher than they were when we met this same time last month, but still at the lower end of where they have been for the year, lower end of where they have been for the past 3 years. If you look at individual products, you can see here that all of these products are, FHA and VA are about 10 bips higher than they were this time last month. Jumbo and ARM up about 35 bips. So everything within the same band. Now, where are these headed? And Mark, again, I always defer to my expert loan officers when it comes to things about loans, because this is their life. They're in it every day. I am too, but not to the same degree. Although I will throw in the caveat here that I study this stuff all of the time. And so when it comes to mortgage rates, I am looking at this stuff very closely. But Mark, I'd love to hear your thoughts on this, whether you agree, disagree. But where are mortgage rates headed? So everything I'm seeing, all experts that I've talked to, everyone is expecting mortgage rates to really stay in this same kind of band for a while. The lowest, the absolute lowest I've seen anybody who knows what they're talking about project mortgage rates to go to in 2026 is the high fives. So I would say if you're making decisions, if you're helping inform your clients for their decisions, if you communicate that mortgage rates are likely going to be in this band from, maybe 5.8, 5.9 to where they're at now, low sixes for the next year, according to the consensus right now, is going to be the case. Would love to hear your thoughts on that, Mark. All right, moving along. The economy. How are people feeling about the economy? And while you let me know, I will do a quick rundown. If you are one of the people who are with me every month, or you're watching this on a video and you've seen many of my past sessions, you can go ahead and brew yourself a wonderful Kenyan coffee right now, or grab yourself some turkey if you've already made it. You can check out, because I cover the same thing every month. But for anyone who is new here, just want to run through really quickly why I spend so much time on the economy. And the only reason I do it here for these purposes is because this is what determines mortgage rates. It's not directly the federal funds rate. It's not any certain metric from a bank. It's not the interest rate you're paying on your credit card. It is specifically all of things that go into the economy. And what is that? Okay, so in the economy, you have employment, inflation, you have retail sales, consumer spending, you have manufacturing output, retail output, all of those things kind of lump into the economy. Oversimplified, yes, but with enough detail to be helpful. Now, the economy, what's going on in the economy, both influences and is influenced by the Federal Reserve. And the Federal Reserve, we've heard them talked about quite a lot lately, probably more than normal. But the Federal Reserve has three primary levers they can use to affect the economy. One is the federal funds rate. And that's when people are talking about what's the rate? Is the Fed going to drop or lower? They're always talking about the federal funds rate. That is the rate that banks can borrow from each other overnight in order to meet their minimum deposit requirements, probably going into much detail here, but if a bank has more than their minimum deposit requirements, they don't want that money to go to waste. This is a lot of money. Even small fractions of that is real change. So they will lend that to other banks. If banks are short of their minimum deposit requirements, they'll need to borrow that from other banks overnight. The Fed funds rate is the guideline, is the band for what the banks can borrow from each other. And it's kind of like the cheapest way, the cheapest rate for cash out there. So then everything else is going to be some level higher than that. So right now, that's the main level the Federal Reserve is using to regulate the economy. Then we also have quantitative easing, quantitative tightening, QE, QT. And quantitative easing is just when they put money into the economy. QT is when they pull it out. They generally don't actively pull it out, but they have been exercising QT as they let some of the QE purchases roll off their balance sheet. And those purchases during the pandemic, they bought billions and billions and billions and billions and billions and billions and billions of dollars worth of a lot of things, but mainly 10-year treasuries and mortgage-backed securities. And as those things have been maturing, they haven't been repurchasing them. So a way to really quantitatively tighten, really pull money out of the economy would be to actively sell those securities. They're not doing that, but they are letting them roll off their balance sheets, and that is having a smaller effect. So you take that, you take the economy, you take the Federal Reserve policy, and then now, kind of more so than ever, you have tariffs and trade policy. All of those things go into what's happening in the bond market. Why do we care about the bond market? Because most mortgages are packaged into mortgage-backed securities, and then they are sold in the bond market, where they are competing with other types of investments, including the 10-year treasury. The 10-year treasury is generally considered a safer bet than mortgage-backed securities. That's why you'll always see a float. If the 10-year treasury is going up, then you have to offer a higher rate on bonds in order to get these traders to purchase them. And that is what goes into mortgage rates. So you don't necessarily need to understand all of that. You don't necessarily need to understand any of that. Just reach out to me or listen to my session and I'll run it down for you. Okay, moving on. And so this is, we're continuing where we have been at for a little while now, because sorry, I'd love to hear this from other people in the comments. So right now, the platform I use to live stream off of, starting this month, they allow the option to do basically a vertical or horizontal reference. And so I chose dual, which is supposed to, if you're watching on Instagram, because most people see Instagram on their phone, it's doing a vertical. So it's going to be small and narrow. If you're watching from YouTube on your computer, it should be broad-based. And just him getting some feedback saying it is hard to read. So if people can chime in and let me know if hopefully it is broadcasting properly on YouTube. So I would just say for anyone out there, if you're watching off of Instagram or Facebook and it's a little small, if you just switch over to YouTube, then it will be, if you're on a computer, it will show in kind of the full widescreen. If you're on a phone, it's going to be smaller and vertical. Okay. I'm actually trying to pull that up really quick myself. Temi, while I'm waiting for this to load, did you have any wonderful insight you would like to add?
No, I was actually seeing how it looked on Instagram and seeing how it looked on YouTube so I can see what the mismatch is. Oh, we have another person that's saying on YouTube it's also small and narrow, so it's not switching over.
Let me take a... All right, I am going to try to fix this in real time. Bear with me.
Ty says that there are 2 feeds on YouTube.
Okay,
So
that's
maybe
how it's supposed to be.
Okay.
Growing pains technology is expanding every day. When we incorporate new technology, usually there.
Some people are fine on YouTube and
you
some
should
people
see
aren't.
the tricky thing is in YouTube, apparently, this is the first time I'm using it, so the first time I'm seeing it, it looks like it doesn't necessarily tell you which is which. So if you are, and maybe Temi, can you drop in a frozen comment if you are watching this on YouTube and you're seeing it kind of scrunched up and you're on your computer, just go pop over to the other screen.
Yeah. Ty says that you can choose which feed that you wanna watch. So you can choose the type of a feed. We can play around with it later. Let's continue to move forward.
Yeah. Yeah. Yeah, definitely. When you go to my channel, you should see both feeds. I don't know if it says which one is which, but if you pick one and it's not right, just go to the other one. Okay, jumping on. You probably recognize this little, wonderful, vibrant boy who just caught an incredible fish that he's going to have for dinner. And you probably recognize him because you saw him last month. And he's what I'm using for government data when the government's gone fishing. So we talked about Q2 2025 last time we met. Final estimate was released at the end of September. That came in at 3.8, so that's a pretty vibrant quarter. Advanced estimate for Q3 was supposed to be released on October 30th. Of course, it wasn't released because barely anything has been released. With the government shutdown, the only piece of data prior to the jobs report that I think was released just now, the only piece of data that was released was the CPI numbers, and that was only released because that's necessary for Social Security and some other things. So that's kind of one of those that you can't miss. What is the Federal Reserve of Atlanta saying right now, though, for what that quarter will be? And right now they're estimating a Q3 GDP of 4.1%, which is interesting because we're going to talk about the economy in more detail. We're going to look at, I've been scrounging around. I've been spending the last few weeks kind of scrounging in barrels and under hoods and in closets, trying to find some additional information about the economy because there is such a dearth of this federal data. And what I've found doesn't necessarily support a Q3 GDP of 4.1. So it's a little concerning because there are a lot of things that are happening that would cause people to believe that the economy is going to be a little bit of a slowdown. As always, Federal Reserve of Atlanta GDP Now model is always the hottest model you'll find. You can look at the blue chip consensus. That's kind of running from the mid ones into the mid threes, which is much lower than the Federal Reserve of Atlanta model. But everyone is still forecasting a relatively vibrant quarter here. Mark, I'm going to get to this a little more in a bit. But that right now, the economy as it has ever been in any of our lifetimes, like, is unreliable. It has never been less reliable, and that's really unfortunate. But we can only work with what we have. All right, moving along. Okay, so sorry, I'm getting a little bit of lag here. So like I said, the CPI numbers did come in for September. That's the one piece of data that's been released from the federal government. That came in at 0.3% increase from month to month. And then the all items 12-year came in at 3% for September after being 2.9% the month before. And so we're seeing, you can see here after inflation, a kind of precipitous drop had been a little bit steady, slowly declining. Now we're seeing it creep back up. No surprise to anyone who's been following the tariffs. But one of the key drivers actually of these numbers was gasoline. Gasoline index rose 4.1% from the prior month and was the biggest driver here. But I just want to note, so yeah, gasoline's a big driver. You'd say, well, Paul, if it's tariffs, why is it just gasoline? It's not, though. Other than vehicle insurance and used cars and trucks, basically every other sector had price increases. So like vehicle insurance, used cars and trucks, that's the only segment of the economy that didn't see upward pricing pressure in most recently reported month. But normally here in November, we would be talking about October data, and we're not talking about October data because we don't have it. It was supposed to be released November 13th. The White House has indicated, talk about, Mark, reliability of the data. The White House has indicated that October CPI numbers will probably never be released. So we might just have a gap there. They might just move on to November. But then my question is, like, how are you going to calculate a month-to-month increase if you don't have the numbers from one of the months? Like you can't just skip this stuff because it's much depends on it. So not sure exactly what's going to happen there. We'll be talking about it in months to come, I am sure. But a lot of gone fishing, and this going specifically to the reliability of the data. So I've been talking about this for a while now, and the picture just keeps getting more bleak. So to summarize really quickly, for those of you who haven't been on the last couple of months. So to come up with these CPI numbers, to come up with the inflation numbers, it's a lot of boots on the ground, manual labor, real work. You have these federal price checkers who are physically going out, checking prices on items throughout the country. And when they're supposed to check a price on something and they can't find that thing, they do what's called different cell imputation, which is they find the cost of that thing in another area of the country, or they find the cost of something like that thing in that area of the country. And they use that to make an educated guess about what that thing would cost there. So the problem with this is that it is an educated guess. And you can see here in these charts, it's covered a little bit by the chat, but actually, I'm going to see if I can pull the chat off really quick just so you can see this really. Okay. So in the past, the number of these guesses, the percentage of these guesses has not made up more than 10% of the overall total. So 90% of the data that the CPI is based on concrete, reliable data. And that's okay. That's pretty solid. That's pretty good. We have been creeping up. You can see now for the past 6 months, these guesses, these educated guesses, different cell imputation has comprised 30% or more of the data compiling the CPI. And now this last month, it was 40%. So we're getting dangerously close to half of the information that makes up these government inflation numbers, the CPI data, which I can't even tell you how many things rely on CPI data, Federal Reserve being a big one. It's like almost half of this is guesses. So how accurate is it? I mean, it definitely not as accurate as it used to be. And I was hopeful that these numbers would get better because the Bureau of Labor Statistics, who creates this information, had gotten an exemption to the hiring freeze. And so they were short price checkers. They got an exemption to the hiring freeze shortly before the government shutdown. There had been postings. They had been seeking additional price checkers, trying to increase their ranks to do a better job at this. But now that we have the federal government shutdown, it's like they're trying to do all of this catch-up work. So they were already behind in what they were doing. They weren't hiring anybody during the shutdown. And now they have even more work with even fewer people. So the prior to the government shutdown, BLS staffing had been down 20% this year. 20% this year. So a fifth of the people were gone. 1/3 of its leadership positions are currently vacant. That was before the shutdown. Even see numbers, presumably people not getting paid, they lost even more people. So this is problematic, it's troublesome, and I'm not very optimistic that it's going to be better anytime soon. So monthly jobs added. Has anyone seen, did the jobs report come in? Okay. Oh. Okay, says the US added 119,000 jobs in September. So that's take it with a grain of salt. How accurate is that? Explain why in a moment. So that kind of belies a lot of what we've been seeing from other segments. Keep in mind, though, that was September, not October. We should have been getting October's data now. So that is dated, and the job market can turn real. When the job market does turn, it tends to be relatively quickly. So 119,000, that's solid. That would be, if we were back in October and we saw that, we would say, okay, the jobs market is kind of holding steady, but all other information is showing that's not the case. And so I do think things have worsened in the jobs market, and I'll talk about why in just a moment, since that September data. Okay, unemployment rate. I'd love if someone wanted to take a closer look to tell me if this is the case or not. I would bet anything it is, though. I would bet that there will be no unemployment rate in the jobs report today. And this is a little bit of inside baseball, but just to let you know why, when the federal government is releasing this jobs report, they have the jobs added and then they have the unemployment rate. And they're both based on surveys, but they're two very different surveys. One's a lot easier than the other. So the jobs added, it's kind of an automated survey. All of these businesses have online portals where they submit their they basically submit their time card and payroll data to the federal government. And so to release this data, all the federal government has to do is just process what they've already received. Relatively low lift. To get the unemployment rate, that is a very manual intensive, phone survey for the most part, a little bit in person, but they're literally calling people, asking them about their employment situation. And so there's no way they were able to do this for September data. And my guess is they'll never provide this for September data because it's like they don't even have the manpower to do what they need to do right now, much less go back and make up for stuff. But then beyond that, even if they did, if you were calling people up and asking about their situation 5 and 6 weeks ago, data is going to be inherently unreliable. So I would bet anything, no unemployment data in the report today. And if there is an October jobs report, I don't think we will see any unemployment rate data in that. Okay, so what employment, jobs data do we have? And we touched on this last month, kind of a lot of the same metrics. We have ADP, one of the largest payroll processors in the country. They reported 42,000 jobs added in October, but this is private only. This doesn't count the government sector. We know government's been a little weak. So this is a reversal from the 32,000 drop in September. So they're saying things are looking a bit better, but it's still not reflecting a strong job market. Education, trade, healthcare, and utilities led the growth. And a lot of those are recession-proof-ish industries. Wait a minute, Paul. I'm seeing a lot of pain in this job market. I've been looking for a job forever, haven't been able to find one. And that is, if you are in professional services, if you are in information, leisure, and hospitality, all of those segments lost jobs. So Revelio, their jobs report, they said the total non-farm estimate, both public and private, lost 9,000 jobs. And that was driven largely by losses in government jobs. So they're reporting a bleaker picture. Indeed is also reporting some semi-depressing numbers. So they're saying job postings are down by 0.5% from the beginning of October. And right now they are at their lowest levels since February of 2021. And then this is what I'm saying. We're seeing some indicators that things aren't as rosy now as they might have been, even if that September data is accurate. And one of those things is that a bunch of large employers, Amazon, IBM, UPS, among others, announced roughly 150,000 layoffs that were coming. And some of those layoffs have already happened now. Some will be happening fairly soon. Typically, we only see this level of mass layoffs when the labor market is starting to turn. But so far, state unemployment applications have been relatively stable. So if you listen to all of this and say, Paul, what are you telling me? It sounds like it's all over the place. Then you're paying attention because it is a little bit all over the place. And that's just the nature of where we're at right now, where the most reliable data isn't there. We're gleaning data from other sources. And it looks like we are in a transition time. And people have been trying to read the tea leaves for a while. We've seen a lot of evidence of a softening job market for a while, and just things haven't cratered out yet. But we have been, they call it low hire, low fire, where businesses are reluctant to let people go, but they're not hiring anybody at all. They're just nervous about where things are, and so they're kind of treading water until things become more clear. But obviously, if that's the situation, and all information is that it is, if we start to see serious cracks in the economy, that's when the labor market can turn right away, because these businesses are trying to, like, what do we do? What do we do? What do we do? It's expensive to hire people. So you don't want to let people go unless you have to. But if the underlying economic environment then necessitates that, it will happen, and it could happen kind of in a heartbeat. Sorry, I saw Maggie's comment pop up on the screen and I missed that. Okay, going on. What was the economic impact of? Oh, thank you, Maggie. Yeah, it is. It is, and that's why you'll see. I don't know if I'm going too far into this, but that's why you'll see this data revised later on, because it's such a mammoth, monumental process to glean what's going on, that as they get more information, as they get more tax information, as they get more concrete employment information, that's when they then revise the numbers that they have. Okay, going to speed it up just a little bit so we can get to real estate stuff quickly. What was the economic impact of the shutdown? It was the longest federal shutdown in history at 44 days. And it's like, there's no doubt it costs the economy, and people are estimating different levels. The Congressional Budget Office estimated the shutdown would cut GDP in Q4 by 1.5%. I mean, just billions and billions and billions of dollars lost here because of the government shutdown. There's an estimate of 60,000 non-governmental jobs lost. And then indirect impact is because of the shutdown and because of this lack of data now, I think we are going to see incredible volatility in financial markets for this foreseeable future. And Mark, would love to hear your opinion on that as well. But I just think we're going to see so much volatility in these financial markets because what they make their decisions on just doesn't exist now. With the gap in data and less reliable data coming, it's like, and then with this data is revised, it'll probably be revised to a greater degree. It's just everybody's making less informed decisions, and they have been making less informed decisions for a while. So if data comes out that is very different from what the market was thinking, we're going to see some major moves in the market, and it'll happen relatively quickly. Okay. This is kind of a fun segment. We are about to get to real estate, but like I said, I was looking under couch cushions, looking in the closet. It's like, where else can we look if we're not getting this government data? And so I pulled up a bunch of things that people actually talk about as what can give you insight into whether we're heading into a recession or not. So mini liquor bottles. People say, oh, when times are getting tough, people who like to drink aren't going to stop drinking. That's for sure. But they can't afford bigger bottles, so they're going to buy mini bottles. So if you track, sorry, hey, this might give you a little insight into whether I think this one's real or ridiculous. But so if you track mini liquor bottle sales, you'll have an idea of where the economy is headed. There's also the champagne index. People say, well, mostly champagne is used for celebration. So if champagne sales are dropping, that means the economy is doing poorly because people have stopped celebrating. If champagne sales are going up, there's cause for celebration. The economy is doing well. Coupon searches. People say, oh, you can look at Google Trends, see where coupon searches are. If they've gone up, that means the economy is going down or people are concerned about it. Lipstick index. There's a thought that when times are tough, people can't afford expensive purchases, so they go for affordable luxury. They go for something that's a little treat, but relatively inexpensive. Thus, people say when lipstick sales go up, that's a sign of bad things happening. Dr. Copper, a nickname given to copper because for quite a long time, if you looked at the price of copper, if the price of copper was going up and was high, that meant we had a solid worldwide economy. If the price of copper was dropping, then that meant we were in some trouble. And that's just because copper is used for everything. I mean, if you ever just want to go down a rabbit hole, just look up all the uses for copper. It will blow your mind. Then there's the Home Depot outlook. Like, how's Home Depot doing? If you just look at how Home Depot is doing, that'll tell you a lot about how consumers are doing. Then there's cardboard boxes. We talked about this in the past. So many things related to consumer spending are in cardboard boxes and shipped in cardboard boxes. So if you look at cardboard box sales, that could tell you. Lumber prices, also talked about that. It's lumber is used for so much. So if following lumber prices, they could be a reliable indicator for a decline in economy and a slowdown in the housing market. And then investors just switching to defensive sectors. It's like, oh, if you have big investors switching to recession-proof areas of the market, maybe that can tell you. Okay, is this real or is this ridiculous? Mini liquor bottle sales. That's ridiculous for two reasons. One, you can't track that. There's no way you can track in a meaningful way the sales of mini liquor bottles. Yeah, they are. They are. Mini liquor bottles are also great stocking stuffers. If anybody would like to give me a stocking full of mini liquor bottles, I will happily take them, even if the economy is booming. But then just in addition to that, like, I'm a Costco shopper. I don't know if we have any other Costco shoppers out there. If times are tough, I'm going to buy a 1.75 liter bottle, and that's going to give me so much more bang for my buck than mini liquor bottles. Champagne index. So a couple of things. Again, lag in the sales data. There's no way you could get that data in real time. Go ahead, Temi.
I was going to say, I will say that Universe Title is famous for giving mini liquor bottles throughout the year at closing. So she would know. Katie would know.
I don't think I'm not famous for giving it to me. I don't know what. Mm-mm. All right, turning it on. We're going to get to real estate data really quickly. I'm just going to burn through all of these. So champagne index. One thing I would say is year to date, champagne shipments are down almost 2%. But yeah, how much of that do you write off to tariffs? Coupon searches. I looked up all this stuff, by the way. I didn't just be like, oh, this sounds stupid to me. I actually looked to see the level of validity I could find here. So coupon searches, they're just all over the place. They don't necessarily track lend credence to this. The problem is beauty sales have been booming for quite some time. If you look at the last 15 years, there's only been 1 year where beauty sales haven't increased from year to year. So that segment is just booming regardless. And even if you had a slowdown, it would still likely be an increase from the prior year. So Dr. Copper, problem is you have surging demand in new industries, data centers, AI. So that market dynamic has shifted a little bit from where it was in the past. Home Depot, this is valid. I mean, this is valid. So Home Depot outlook, because people are spending a lot less money at Home Depot. And what does that mean? It means people are putting off doing big projects. People are putting off home renovations. There's less contractor work out there. I know a lot of contractors, below a massive level, a lot of contractors source from Home Depot. And so this is the quickest decisions people can make to save money if they're worried about money. And this is one of them. So Home Depot outlook, I'd say that's very informative as far as where we're going. And then cardboard boxes, I mentioned this before. This is very real. Cardboard boxes are needed for the overwhelming majority of things in consumer spending. And in Q3, corrugated box shipments hit their lowest levels in a decade. So usually they increase leading into the holidays, and they didn't. Depending on which manufacturing plants you looked at, it's like the levels were either stagnant or they declined. A couple of weeks ago, one of the biggest U.S. cardboard manufacturers indicated that they would take downtime at their facilities. Basically, they're just going to shut down their facilities for chunks of time to lower output because of weak demand. Okay, lumber prices. That is real as well. We talked about this before. Falling lumber prices are a very reliable leading indicator for a declining economy and a softening housing market. Lumber futures have dropped by more than 10% in the past month. I mean, that's a very sizable impact. And then the framing lumber composite is down 6.5% year over year. There are basically three main things you look at if you want to know lumber prices. It is the futures index. It's the framing lumber composite. Just talked about those two. They're not looking good. And then you look at the Bureau of Labor Statistics producer price index for lumber. Those are the three things to look at. We don't have the third one, obviously. And then investors shifting to defensive sectors. So you have a lot of very, very smart people whose livelihood or whose wealth depends on protecting a lot of money. And where those big chunks of money are going is indicative of where the economy is headed oftentimes. And defensive sectors, by the way, are like utilities, healthcare, consumer staples, things that do well regardless of the economy. So they're kind of safe havens to park money when people are worried about where things are going. So when people expect an economic slowdown, money goes into these sectors, and that is happening. Those three sectors were set to lead the S&P 500 for the first time in more than 3 years. And investors have also been pulling back from sectors that are more sensitive to the economy. Does this match how people are feeling? Yep, it does. People are feeling much, much worse. The University of Michigan survey, which is considered the gold standard for consumer sentiment, they had consumer sentiment at a 3-year low and close to the lowest point ever. How are people's clients' feelings? Like, let's drop in some comments about how people's clients are feeling. All right, I'm just going to speed through this. So Federal Reserve, they're meeting next in December. They last met in October. Nobody knows what's going to happen. There's no point in spending a lot of time in what's going to happen because nobody knows. At the time of their last meeting, almost 90%, like the market experts, people who you talked about, expected a rate cut in December. Now it's 50-50. I don't even think Chairman Powell knows what is going to happen at this next meeting because the Board of Governors are very go after rising inflation or a softening job market. You can only do one. Like you can only, if you lower the rate, that spurs the economy, spurs the job market, hurts inflation. If you keep the rate the same, it helps with inflation, but could harm the job market. So I think it will be like, which one of these do the majority of people think is a greater problem? And then they're going to tackle that. But right now it's anyone's guess as to what is going to happen. 10-year Treasury, it is up just a little bit from when we last met. Retail sales, we don't have this data. We don't have any of this data. Of course we don't have this data. Brookings, I'm going to include this as frequently as I can because local information is more important to us locally. But Brookings Institute has not updated any of their data since last time. All right, what is happening in the DMV real estate market? What are people seeing? And we are going to take the 30,000-foot view while people chime in the comments. But one thing I want to note, I talked about last month. I said typically all reliable analysis of past government shut of the market softening, transactions declining, going into pending transactions declining, going into a government shutdown, staying depressed during the shutdown, and then rebounding afterwards. And I just want to let you know we're not going to see that data here because it's too soon. The most recent data, all of the monthly data is from October. The weekly data is only as recent as the 16th. The government, quote unquote, reopened on the 13th. But I don't know if you've ever seen video footage of an aircraft carrier. It takes like 10 miles. Like, they are nimble compared to the federal government. Like, to fully ramp back up and get things back to normal is going to take a little bit of time. And also, as of today, I think there's still a fair amount of government workers who haven't received back pay. And that's important. They're not able to put that money into the economy. If they were saving money for a down payment, they're not able to have that money just yet. So we're not going to see any of the effects of the shutdown stopping in any of the data we're talking about now. We'll see it next month, though. We'll see it next month. Okay, so we are on track. If you've been in real estate for a few years now, it's the underlying market is looking different, but the result is the same. We are on track, almost identical pace of last year. Right now, we're on pace for 49,751 homes. Last year's pace was within a couple hundred of that. Year to date, we are within 200 transactions of where we were year to date last year. Median sales price, though, this is interesting. So we were seeing kind of a creeping slowdown. You can see this in the chart here. There were a lot of months where we had jumps in median sales price from around 5 to 10%. And then slowly that was 2%, 3%, 1%, 2%. And last month, it was 1/3%, just a small increase. This past month, back up to 5%. So I had thought there was a chance we might actually see a negative number because of some slowdown signs, but nope, it's quite a bump. And we'll look at county specific data on that very, very soon. So this is, if you have buyers who are waiting, I said this before, this is now the 29 straight months of year-over-year DMV price appreciation. So it depends. If various segments of the market, you can get some better deals. But overall, if you have buyers who have been waiting for mortgage rates to go down and property prices to go down, the only result of that wait is them spending more money for the same thing than they otherwise would have been. All right, closed sales and new pendings, both are pretty close to last year's levels. So this is a band we've been in for quite a while now with closed sales and pendings. They've been within a few percentage points of where we were at the same time last year, and it's even closer here. So it's right on track with where it has been at the end of the past 5 years, very close to where we were at last year. But don't take this at face value. This signifies because all things being equal, we should have seen a jump in new pendings and buyer demand within the past month or so. So all things being equal, we should have seen a jump. And that is because last October, mortgage rates were in the process of going from the low 6s to the high 6s. Whereas now we've been declining a lot and in this low band. And so just based on that, mortgage rates are kind of the biggest driver of transactions right now. And with that change, we should have seen a spike. So since we didn't, having it even softer than you would think if you're just like, it's the same as it was last year, because it should have been stronger. All right, moving on. New listings. So new listings are up 4%. Last month, if you remember, they were up by 12%. And I was asking the question, like, is this the sign of a greater shift in our market? And so far, it doesn't seem like this. It varies from county to county, but 4%, that's a relatively small bump in new listings. We are still having a lack of inventory throughout the area. So this is something I'm still going to pay close attention to going forward, but it doesn't look like just abandon the area. And then we're seeing the same thing in active listings. So this increase in active listings. And I just want to note, because I think it's really important to have accurate data and an accurate understanding of what is out there. And there's a lot of things the administration has been doing, which has had a negative impact on the economy and the real estate market. And it still can be, but I just want to note here with inventory, it's not only because of the new administration. We have been seeing inventory levels increase in the DMV going back well before the start of this new administration. And the last thing I just want to touch on here is to always tie it to 2019 levels. And we're getting closer to kind of action count. Last month, we were at 89%. Right now, these numbers are at 88%. So we're closer to where we were at. There were like years where we were in 50 and 60% of the inventory of 2019. So we're getting closer, but even with these increases, still not really at a quote unquote normal level. And then something, don't do this every month, but wanted to touch on because Bright released their Q3 luxury summary for the area, which includes DC. For luxury, they define, I'm not defining luxury, might define it as those lipstick purchases or champagne or maybe even the mini liquor bottles. But according to Bright, luxury is defined as $1.725 million. So that when you're seeing these numbers, their property's priced at 1.725 and above. So just want to touch on, excuse me, the luxury market is much stronger than the overall market. So the number of new pendings on luxury listings jumped by 20% year over year for the quarter, compared to a 2.1% decline for all other segments. So that's pretty massive. For the quarter, we had a 20% increase in new pendings for luxury when everything else was declining. And then luxury prices rose in Q3 by 3.3% compared to 2.4% for the rest of the market. Those numbers, we talked about most of them, but they're in the deck if you want to take a closer look. Okay, now we're going to go into county-specific data. Median sales price. So this is much more consistent than it was last month. All areas other than Frederick had an increase in median sales price. So Nova, and this has been consistent, we've been seeing this in a lot of the different metrics. Northern Virginia is the strongest area, and then Fairfax is up by 8%. Alexandria and Arlington, like I said, are up by 20%. And just when you're taking a look at these numbers, it's a little confusing the way I portrayed the charts here. So the percentage increase, you can see that by looking at the my brain is spacing. What's the thing on a map that tells you what? Anyways, if you look at the axis on the left, that'll tell you where the percent increase are. And then the numbers are the actual number of the median sales price. And so it might be a little confusing when you're looking at it, but I thought it would be helpful just to understand where median sales price is, because pricing varies tremendously throughout these areas. And so that'll just kind of give you an idea of what exactly the median sales price is. And then if you look at the percentage change, that will tell you what the difference is. So interesting to note, a lot of us do a lot of business in DC. DC has now gone 9 straight months, either near even sales price or increases in sales price, which is surprising. Although this month was solely based upon detached homes, there was a sales price drop in townhomes and condos. Okay, going along to closed sales. We've already discussed kind of how overall sales were close, basically even, but it tells a different story when you break it down. Northern Virginia continues to be strong, up by 7-11% between Arlington, Fairfax, Alexandria, Loudoun up 3%, Frederick up 6%. Montgomery County was down 2%. And then Prince George's County and DC were both down by more than 9%. In this in all of the data. The weakest markets, the softest buyer demand relative to supply is in Washington, D.C. and Prince George's County. And we see this in almost any metric we look at. And new pendings, this continues in that. So it's hard to make too many generalizations right now about what's happening in the metro real estate market overall. But a couple that you can is the one I just did. Buyer demand is weakest in D.C. and Prince George's County. Pendings down huge in D.C. by 15.5% and down by 5% in Prince George's County. And then, like I said, Northern Virginia across all metrics overall from month to month is still most consistently a hotter seller's market than most of the surrounding area. So other than that, Fairfax is down 1.1%. Other than that, in DC and Prince George's, Frederick was up huge by 18% in new pendings. Days on market. So this is it's a little confusing what's going on. We're seeing prices increase. We're not seeing a massive increase in inventory, a little longer to sell. So there's a bit of a disconnect there. And this has been the case for months now. For months now, we've seen year over year increases in days on market. And so no shocker, Prince George's County and DC have the highest days on market. What is surprising though, and I would give someone a gold star or a mini liquor bottle or some chocolate or whatever, if they would like to look up and find the last time DC, prior to this, DC didn't lead the area in days on market. So I think DC has been highest days on market for years now. And I took a quick peek around, but didn't find, and I can't recall when the last time before now was that DC didn't have the highest days on market in the area. But for October, it was Prince George's County at 29, DC right behind at 26. So everywhere else other than Frederick is right around 2 weeks, and Frederick is a little over 3 weeks. And so, make sure you're taking all of this within the proper framework. This still means that the majority of homes in the area are going under contract outside of DC and Prince George's County in 3 weeks or less. Homes are still selling relatively quickly, just might not feel like it compared to some of the markets we've had. Okay. And now we're going to look at months of supply. And this is also continuing the trend we've seen for a bit. Days on market are increasing, creeping up everywhere. Arguably an even market. Some people who are in that market or trying to sell a home that's been sitting might say it's a buyer's market, but the metrics support a fairly even market. Everywhere else has no inventory. For the past few months, I've done real-time lookups. I'll pop in and I'll manually pull data to check that inventory hasn't boomed up. But just from looking at a variety of other metrics in this, I know it hasn't. So didn't spend the time this time, but I can tell you there's still no meaningful inventory anywhere in the area outside of DC. Okay, new listings. DC down big. DC's down big. It's like DC is just, people are taking a break. And if you have any idea of what's been happening, it's not surprising. I mean, first there was this huge National Guard presence in the city, just a massive military presence in the city that affected everything. And hotel vacancy is down, and restaurant spending is down, and retail spending is down. And then you have the government shutdown, and then you have a lot of government layoffs. And so it just seems like there are a lot of buyers and sellers in DC who are maybe just overwhelmed by the uncertainty, and they're just putting things on pause. Other than that, new listings, Loudoun was up a little under 2%. Prince George's was up a little under 3%. Those are both close to even. Everywhere else was up 7 to 11%, except Arlington with a big 19% jump. And this is also why it's helpful to show these numbers. Like Arlington had 200 new listings. And so it doesn't take a whole lot of properties to give it a 20% bump for the monthly year over year. Now, active listings, DC had the smallest year over year increase at 13%. That was because, as we saw, they had a decrease in new listings, but then also DC's had higher inventory for quite some time. So keep base effects in mind. DC was already a softer market this time last year. So in a lot of these metrics, their change isn't necessarily going to be as dramatic. So they had the smallest increase in new listings at 13%. Loudoun up 26%, Fairfax up 35%, everywhere else up more than 40%. Nova up big with Alexandria 50% higher, Arlington up 64%. But just keep in mind, and for those wonderful people who have been joining me month after month after month for years now, I love you all, and you probably get tired of me saying some of these things. But it's important, if you're hearing this for the first time, even a 50 to 60% increase of nothing is still basically nothing. And inventory has been basically nothing for quite some time. So it's like 50% increase in inventory in Arlington and Alexandria. It's like there's still no inventory. There's still inventory in those places. Okay, quick pop on to showings, and then we're going to move on. Showings about even overall, but as you can see, that varies a lot from area to area. No surprise, given what we've talked about, that Prince George's County and DC have the lowest showing numbers out of the area, and showing levels are close to even or up everywhere else. Okay, weekly snapshot. So this is looking at the latest data, and I want to reiterate in case anybody, I put anyone to sleep earlier, or taking a quick nap, when I said that none of this data will capture the effect of the government reopening, because this is the most recent weekly data from November 16th, but the government didn't reopen until the 13th, and some federal workers haven't been paid yet. So this doesn't show a rebound in the market, but it's not surprising because I'm not expecting to see that until we see the full November data and then the December data. So everything holding pretty close to steady, other than active listings, which are up 34%, which we saw from last month, were up 35%, and they've been in that 35 to 45 band for quite a while. If you break it down by area, it's pretty much the same thing too, with you see pendings. So pendings are about even. And if you look county by county, that's pretty close to what's happening so far for the month everywhere except for Prince George's County and DC. Pendings in November are down in both of those areas by a fair amount. And buyer demand continues to be strong going into November in Alexandria and Arlington. Now, I don't have a slide for this. Whoa, almost spilled my coffee. But I want to hit really quickly. I wasn't going to touch on it because it's just so dumb. Like, it's so dumb. And I assumed you have some consumers, some people who don't just deal with real estate all the time and who might catch the video later. I thought it would be important to quickly talk about the 50-year mortgage. In the comments, please, if anyone thinks the 50-year mortgage is a good idea, please let me know. I do not, which is why I wasn't going to cover it. I thought it was so obvious, but just in an abundance of caution, I just want to state. So if I were to take 2 sheets of paper, one label all the pros of a 50-year mortgage and the other all of the cons, I would save a tree, because there are no pros. There's not a single reason for a 50-year mortgage. Like, not a single reason. It's one of the dumbest things I have ever heard. And this is what happens. I don't want to get into politics, but when you have a process where things don't get vetted properly before they get publicly announced, and then you have to pull back, which is what happened. So this probably, I think it's dead in the water. But median age of a first-time home buyer in this country right now is 40. If people think, oh, it's not that high, Paul, it is that high. It's been creeping up for quite some time. So median age of a first-time home buyer in this country is 40. Average life expectancy is 78. So let's start a process here where people's mortgage obligations will exceed their life expectancy. Like, that's just dumb thing number one. Dumb thing number two is that it would lower the cost in a meaningful way. The rate would have to be higher on a 50-year mortgage than it was on a 30-year mortgage. You look at the 15-year, the rate is lower. And so presumably it would have a higher mortgage rate. And so the cost savings would be minuscule. And what would be the cost of those cost savings? You would, over the life of the loan, you would pay about double the amount of interest. And then also, after 10 years, the amount of equity you built in that home just from your mortgage payments would be about 25%. So it's just like in every way. Yeah. Virginia's right. You'd have a longer, more stable cash cow there. Okay. Key takeaways. We are wrapping up. I'm almost going to finish on time here. So key takeaways for consumers and real estate industry pros. So this has been up here for a while, but it's more important than ever for, if you're a consumer, to rely on experts who understand this market. And if you're working in the market, like I am, like Tammy is, like our colleagues are, it's more important than ever to stay up on this stuff, because we're just dealing with like unprecedented event after unprecedented event. And you really need to have a thorough understanding of what normally happens in the market and follow this data to have any clue of understanding what will be happening. And then the other, so going in, expect major market volatility. We're going to start seeing some more concrete economic data come out. And if that varies at all from what market assumptions have been and what all of these traders and finance people have been basing their decisions on, we could see very immediate and massive market movement. District of Columbia, it's hurting right now. A lot of buyers and sellers are on pause. If you're a seller or a listing agent, you need to know your market because of all the reasons I have talked about. But outside of DC and Prince George's County, it is still a very good time to sell. More buyers than there are sellers, and sellers will have a lot of success so long as they list their property, properly. And it's still not a bad time to sell in DC or Prince George's County. Like I said, the data is showing it's an even market. It's not a buyer's market, it's an even market. But more important than ever to price your property appropriately, preferably in decent condition, and then still a pretty good time to buy overall. I mean, mortgage rates are at the end of where they've been at for the last 3 years, and prices just keep going up. So waiting isn't necessarily going to get you anywhere. I talked about how mortgage rates are expected to be in the same band for the next year. And so in all likelihood, if you wait a year to purchase, you'll be paying the same for a mortgage for a higher priced property. All right. Wow. Oh, I thought it was 9:30. I thought I ended on time. I was going to congratulate myself, but I didn't end on time. Pretty close though. Thank you. Still see we have most of the crew sticking around. I will stay on for a couple of minutes. There was a lot of stuff to get through here, so I know I missed a fair amount of comments in the chat. If anyone has any questions they want specifically answered here in real time, I'll stick on for a few minutes. If not, we can call it a day. Temi, any closing thoughts?
No, I think the only thing is learning more about the 50-year mortgage helped me appreciate the 15-year mortgage. I didn't really take the 15-year mortgage seriously until I found out how the 30-year mortgage kind of got started. And so I was like, oh, this is so interesting. But yeah.
Yeah, I know, Temi,
What?
you were
Hey,
lagging just
Jade.
a little bit there for me, so I'm not sure if you were for other people. But if anyone didn't catch all of that, Temi was just saying how it made her appreciate the 15-year mortgage more. And yeah, it's like not a lot of people take advantage of that. I mean, oftentimes when you're buying a house, you're kind of stretching your financial ability, but if you can absorb those little bit higher monthly payments, there's a lot of benefit that comes from that. Great having you on here, Jade, Ty, Christina, everyone else. Thank you for joining. Yes, that is accurate, Mark. The prevailing sentiment, and the sentiment was only expressed by me, but I have the loudest voice in the room for this session. But yeah, 50-year mortgage, bad idea. All right. Hope everyone enjoyed the Thanksgiving holiday cheer theme on this edition, got some value out of it. If you are watching in the video, would love to hear comments about what you liked, what you didn't like, how I could improve, or what you'd like to see next month. All right. Thank you all. Thank you, Temi. I'm going to go with Temi the Great. That's
not
yep.
Temi with the good hair. Paul, are there any changes to December because of Christmas? Are we like doing third? Because are we usually third
No,
or
I was
fourth?
going to
Oh,
keep it the
we're third.
same because
Okay.
it's third Thursday, so that's the 18th. So the next week would push
So we're
it
good.
onto Christmas. Yeah, so we'll be going on the 18th, and I'll have also, I'm gonna be dressed up, maybe not as Santa Claus, but I'm gonna have some holiday gear on. You're gonna see some lights in the background. We're gonna have lots of fun.
Love that.
All
Your
right.
favorite Christmas coffee.
Thanks, Temi. Thanks all. Yep. Thanks, Gene. Oh, I have 2 advent calendars coming. I've got a new coffee a day from 2 different entities coming in December. I'm probably going to have 3 different coffees I'll be brewing on that day. All right. Bye, guys.
Bye.